Today we're going to talk about theta. So in the previous video on stock options, we talked about delta. We're going to look at Pfizer, PFE, and we're going to take a look at all of the Greeks in this call option. So if you remember, delta was the probability that the call option expires in the money. It also represents the amount of money you expect to gain for every $1 change in the stock, in the underlying. So imagine Pfizer moves up $1 in the stock. Depending on the call option you buy, if you're buying a call option. So for example, yesterday it moved up $1. So if you had bought this call option, we'll click on the Greeks. If you had bought this call option, you would have gained $36. So that's delta. But delta, while when you buy a call, delta is your best friend. Theta is going to be your worst enemy. So let's just grab a model profit high stock option and take a look at the delta and the theta in tandem, because together they represent your risk and reward. So here we got delta of almost 100. So this is so far in the money that it mimics the stock. Pfizer is currently at almost $31, and this strike price is 27. So we're down $4. So it's very far in the money, especially for a stock that's not volatile like Pfizer. So what we get is a stock option that mimics the stock, mimics 100 shares of the stock. However, the difference between this stock option and actually buying outright 100 shares of the stock is your theta. Theta represents how much money you're losing per day by holding on to that option. So if you have a theta of 24 cents, you're losing 24 cents every day on this stock option just due to time decay. And it's going to end up at zero. Theta is going to be, the stock option will become zero if theta eats away all of the cost, all of the value of the stock option by this expiration date. And that would only happen if Pfizer dips below 27. But that's how you should think of theta. Now, theta, while you buy a call option, can be your worst enemy because you're eating that theta each day. It can also be one of your best friends if you decide to go long on theta, or if you decide to write an option. So you can take the opposite side of this trade and you can sell the call option, and that way you're actually gaining 24 cents per day. But on the downside is that stock option is very far in the money, and the probability that it expires in the money and you eat a loss is very high. So I'm going to show you another strategy where you can make money through theta without the risk. Now take a look at Pfizer. It basically trends sideways. We haven't seen it move very far in the past couple months. It's been in this 28 to 31 range for quite a while. Now based on that, if you find a stock that's trending sideways, you can open what's called a calendar spread. And we're going to take a look at the theta in the calendar spread. So you can use a call or put. B2B just means back to back. We're just going to look at that because it's the simplest one. And let's choose the calls. So in a calendar spread, what you're doing is you're buying a call with an expiration date way out there, and you're selling a call with an expiration date that's closer to the present time. So we're just going to choose this one, and you can see that the strike price is basically at the money, and that's what you want to do with a call option or with a calendar spread. You want to buy and sell call options with the same strike prices, and you want those strike prices to be pretty much at the money, and that's where we're at. So this looks like a pretty good call option. Now let's look at the details. Delta is always going to be very close to zero. We don't care about delta. We want the stock to trend sideways. We're making money through theta. Now this option is technically making us lose money, 9 cents per day. But the key here is that if the stock, if the underlying ends up at 31 on May, at May's expiration, we're going to have the time decay here be much more than the time decay here. This is probably not a good example to explain this very well, because it would be better to look at these options individually. I don't know if we can do that. And you'll see that there's a difference in theta. Now like delta, theta is additive. So if you have a high theta and a low theta and you're opening a position with options that have differing thetas, you just add them to figure out your theta. Let's look at a different type of play. it'll make more sense here. But generally, if you want to make money through theta, your best bet, well, you have lots of options, but your best choice is generally to find a stock that's safe, trending sideways, or slowly trending upward, and then choose the appropriate strategy. If it's trending sideways, you're going to go with a calendar call. If it's slowly trending upward or downward, you generally want to go with a credit spread. So let's look at a credit spread. I don't think Pfizer is trading in either direction very consistently, but I do know something about this stock. It is currently undergoing $5 billion worth of buybacks, and that's going to inflate the stock price. So I would rather be long on this stock than short. And in that case, what you want to do is you want to get a bull put credit. In a bull put credit, you're selling a put, and that's what you usually want to do when you're going to be making money on theta, but you're also buying a put to protect you against the theta loss. So let's just go ahead and take a look at one of these. You're selling the 28 put. So your assumption, sorry, you're selling the 37 put. I don't like that one. Let me grab a different one. I'm going to grab one that makes a lot of sense. All right, this will make sense. Okay, so it's March right now. We've got 1 week. We've got 5 days until these options expire. Now we can sell this option right at the money, and we can gain immediately $118. Now the reason we're making money on this is because of theta. That option is losing $2.97 per day. So after a week, and by the way, theta increases with time. So after a week, this will be worth zero. So we've sold it for $118, and we've gained that $118 up front. And what we want is for Pfizer to be above 31.5 by the end of the week. And if that happens, this option's price goes to zero, and we make money because it's worthless. We sold something that's worthless. We got money up front for it, and we're all good in that way. That's making money through theta. So you just think of it like this. You're making $3 per day by keeping this open. That $3 per day is actually increasing. So tomorrow it's going to be $6, and the day after that might be $20. But the idea here is you can use theta to your advantage by writing options. Now, people don't like writing options because you're on the other side of a long options trade, which means that you expose yourself to very, very high amounts of risk. However, the advantage of a credit spread is that you buy another option. You buy for a put spread, for example, you'd buy a put of a lower strike price, and that protects you against max risk. So the way you calculate your max risk is you just subtract these strike prices and you multiply by 100, and that will give you roughly this. By the way, you also have to subtract the money that you got up front, because that's to your advantage. So you subtract these two strike prices and then multiply by 100, and then subtract this, and that's your max risk. Now, obviously the risk here is a lot higher than the max profit, but when you're trading theta, you're generally looking for lots of little pieces of profit and not one big profit. So it's the opposite of when you go long on a call option or long on a put option. When you're going short on a long or short on a call option or a put option, you're just looking for a little bit of money each day through theta. So that's how you use theta. Now that you know about theta, you can use theta and delta in conjunction to figure out what your optimal play is. Remember, delta is the price you'd get when a stock moves up or down. It's the money you get for each dollar movement up or down, and theta is the money you get for each day that you hold on to that option. So putting those two together, you can sometimes even find positions where you're long theta and you're long delta and you're long theta, or you're short both. So playing around with all these different option strategies, you'll get the hang of when to be long on theta, when to be long on delta, and vice versa, or short on these two Greeks. But when you analyze an option, these should always be in your mind somewhere. You don't want to always be long on calls without hedging for theta. So if you have a bull call spread, for example, what you're doing is you want to be very long on, you want a high delta, but you also want a low theta. Now if you had just bought the call outright, you would have a very high delta and a very high theta. You'd be eating a lot of money per day, but you wouldn't be getting, and you'd be getting a lot of money for each dollar increase in the in the underlying. But what you do when you open a debit spread is you sell another call that's higher. So in this case, instead of just buying the 25 call outright and eating a high theta, you're going to sell above that a 30 call. Your delta is going to drop. It's still pretty high, $42 for every $1 movement upward. It's still pretty high, but your theta is very low. It's close to zero. Now, the theta we saw before was even lower, but that's not typical of a call option. Usually your theta is going to be, for example, for a May option, it's usually be pretty high. The reason it looks low for Pfizer is because Pfizer is just not volatile at all. So for example, if we took a look at something that was volatile like Guild, you'd see a lot higher theta values in these call options. So let's just take highest model profit. And as you can see, the theta is $2 a day. Now this is something you generally want to hedge, and you hedge it by selling the weeklies above it or by selling the monthlies above it. That's called a diagonal spread, or you can just go ahead and sell the exact same month but with a higher strike price. So we'll take a look at one of those. And keep in mind that your delta is always going to be very high when you just outright buy a call option that's in the money. And your delta is always going to shrink when you switch that to a debit spread. So check it out. Delta is 22, but we're pretty far out of the money, I believe. What is Guild at the moment? So Guild is down there at 89, and it is pretty volatile, especially compared to Pfizer. But yeah, we're $10 out of the money there. But still, delta is pretty high for this option. $22 increase, even though we have to move $10 to actually get at the money. For that reason, our delta is going to be pretty high. Our theta is going to be pretty high. Now, if we look at a debit spread where we sell a call option above the bought call option, we're going to see that theta a lot lower. Now, this is clearly a more expensive play because this April strike price is way in the money. So the original call costs more than $1,000. But in this case, I believe our theta, so I was mistaken before. We just looked at some arbitrage plays when we saw that theta was positive, so that was a mistake. When theta is negative, that means you're losing money each day. And when theta is positive, you're actually making money every day. So the fact that these two are the same monthlies but have different strike prices gives them different theta values. Now the in the money Guild call has a lower theta than the out of the money Guild call, and for that what we do is we see that the theta in total is actually positive. So we're making money on this out of the money call through theta, and we're also making money when Guild goes up $1. We're making $51. So this is one of those plays that I just mentioned where you can have a positive delta and a positive theta. You're making money in two ways. You're making money just by holding onto this option strategy. You're making $3.75 per day. But you're also making $51 every time Guild moves up by 1. So here, you don't need to worry about time. And all you really care about is that Guild moves upward. Now, obviously, a movement downward will lose you $51, and you're going to have to wait a while for that theta to bring back that value. But in the end, you're pretty much hedged on theta so that you're making money on theta, and you're making money on delta, assuming that your directional prediction was correct. So if you believe that Guild is going to move upward, and you want to make money on that without having to worry about theta, instead of just buying outright the April 75 call, what you do is you'd buy the April 75 call, and above that you would sell the April 90 call, and that way you're making money just by holding on to the option, and you're making money as you wanted to when the stock moves upward. The only downside of this strategy, selling the April 90 call above the April 75 call, is that you lose out on some delta here. So without the 90 call, your delta might be, I'm guessing it's going to be 70 something. So you're losing $20 per upward movement, but you also don't have to worry about yield moving upward each day. So if it drops one day and you're swing trading instead of day trading, you don't have to worry so much because you're making money each day regardless. So that's it. Whenever you look at an option, make sure you're looking at theta as well as delta, even if it's a directional play. So theta can help you in two ways. It can limit how much you're spending on those directional plays, and it could also make you money if you want to bet that a stock is going to trend sideways. And again, to make money that way, you're going to be looking at those calendar calls or calendar puts. Any calendar spread will work. There's also other sideways strategies, iron condors, iron butterflies. They all work out to where you're making money through theta. So these are your two money makers, theta and delta. Later we'll probably talk about gamma and vega. They're also very important. You can do pure vega plays, and gamma is not if you understand delta, you pretty much understand gamma. Gamma is how delta changes. So generally when you are long on a call or put, you're implicitly long on gamma or delta, except for when you're doing these credit spreads or these debit spreads. We could talk about that later. But overall, you know about delta now, you know about theta now. They're both good money makers. A lot of option traders say that they've made most of their money through theta. Others, very few, not few, but I mean most people who are making money long-term through options are doing it through theta because it's just safer, it's easier. But if you want to get those occasional big directional plays, you've got to do it through delta. Either way is fine. If this video is helpful, please like it. Also subscribe, and in the comment section below, leave any requests for videos and I'll get to them.